more than just business news, we're news for business people.
Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Joining me on the show is Agam Vakil. Agam will speak about the FNOQs and I'll talk about the general trade setup, which looks decent at least as far as the equities is concerned, because global markets have, except for the US markets, most of the other Asian markets are doing well. The SGX Nifty is indicating a gap up opening, has come off the day's high, but nevertheless a positive opening is something that we can anticipate about the 10,500 mark in trade. Now, as far as the ADRs are concerned, a big drop came in Vedanta, given the fact that LME based prices saw a big sell-off. Apart from it, Wipro, ICICI Bank and Tata Motors were also down in trade. Marginal gains coming in from the other counters like HDFC Bank, Dr. Reddy's and Infosys. Now, crude is the big talking point, and there was this big sell-off of 2.5% in trade yesterday. The US stockpiles actually showed record production, and that is why crude is down in trade. So if you're looking at WTI crude, it's almost down 0.6% below, closing in on the $61 barrel per mark, and the Brent crude is below the $66 barrel per mark. So for the fifth or sixth day in a row, we are seeing selling on the crude side. As far as base metals are concerned, just take a look at the sell-off that happened. Aluminium was okay, but copper and zinc were down almost 2 to 3%. Nickel was down 1.5%. Lead was down almost 4.5%. So that traction seems to be on the weaker side. Even what's happening with China, copper is opened down almost 2% there. Zinc has actually extended the gain to a drop of almost 1.3%. Aluminium continues to remain steady, and steel has managed to move on in the negative. Even as far as the precious metals are concerned, there's no traction happening. Despite volatility, all the precious metals are trading with a flat or a slightly negative bias. FIs used the opportunity of the move yesterday to sell. They sold in 1,000 crores. DIs bought in almost 460 crores. So overall, FIs with this sell of 1,000 crores become net sellers for the month, and DIs become net buyers to the tune of 2,500 crores. As far as the stocks are concerned, the Nifty underperformed yesterday. It was down 20 points, but the mid caps and small cap did manage to rally significantly. Which were the sectors? The marked underperformance came in from the IT sector. The outperformance came in from the real estate sector. Now, the Nifty was down 20 points. What contributed? HDFC Bank, L&T and TCS were the primary reason which led to a drop on the Nifty. But Agam, what are the FNOQs indicating?
Sure, Darshan. Not too much to speak for when it comes to changes in open interest, at least as far as the Nifty is concerned, because we're looking at flattish movements for the open interest, and the underlying, of course, declined by as much as 0.2%. The cuts in the Nifty Bank were slightly deeper, however, less than about 0.6, in fact, 0.5% there. But we have seen about 8% jump in open interest. That said, in terms of volatility, as one might expect, we did see that come off to a certain extent by around 3%. Still below the mark of around 20, but when it comes to the put call ratio, that hasn't changed too much. They're currently standing at 1. And in terms of changes in open interest, we are looking at more writing around the 11,000 call and the 10,800 call. On the other hand, in the far end, we are also looking at the 10,000 put, which has been written quite substantially. What else are we keeping an eye on? GMR Infra, that's the new stock which enters the FNO ban, expected restricted trade there. We're expecting fresh longs in Voltas. We've also seen fresh longs in other counters like Dish TV. On the other hand, weakness comes in for PC Jeweler, so some amount of fresh shorts building in that counter. And on the whole, once again, all eyes will remain on the benchmark indices. Well, that said, the recent sell-off was long overdue, says Peter Oppenheimer of Goldman Sachs, speaking to Bloomberg's Tom McKenzie. Oppenheimer said that the return of volatility and the recent corrections have provided good opportunities in the US and Europe. Listen into a slice of that conversation.
I would say that what we were really flagging in that note is that you had a combination of factors that meant a correction was quite likely. First of all, you'd seen the longest period since 1930 without a correction of at least 5% in the US, the longest period in the global market, the MSCI World, since it started in 1970 without a correction of that magnitude. We'd also seen the strongest start of the year up until this correction started in any year in the last 30 years, despite the fact that bond yields were actually rising. And most of the sentiment indicators that we look at, our own bull-bear index, our GS risk appetite index, all of these were really at record highs. So we felt there was a good chance of a correction. But I should emphasize that our anticipation was that there would be a correction within a structural bull market. And that's still the view that we have.
Is this suggesting to you that indeed what we saw was a correction, we're not heading into a bear market, but you could see further corrections down the line in 2018, particularly as volatility comes back to the surface?
A good point. I think that it was important for volatility to re-establish itself because the markets were getting carried away, I think, with what has been, as we described, a very Goldilocks environment, at least in the last year, where global growth was accelerating, expectations were being beat in terms of growth. It was very synchronized, but we had very, very low and stable bond yields and extremely loose financial conditions. Bear in mind, until this correction, US financial conditions on our measures were looser than they've been at any point since the financial crisis. So that was really contributing to this melt-up with very low volatility. And I think having some volatility coming back into the market and having valuations coming back to a more appropriate level is quite a healthy thing. But I think the markets are still a little bit vulnerable to a slowdown in the growth momentum, if we see that in coming months, and any further rise in term premium in the bond markets.
But what it has done is it's presented some buying opportunities, right?
Certainly
Where
it
are
has.
those?
Well, first of all, I should say in aggregate, we still like equities. You know, our forecasts are for equity markets across the world to rise through to the end of this year at a lower pace, a slower pace than we've seen up until this correction, and a slower pace than we saw last year. The best return forecasts that we have are outside of the US, predominantly in emerging markets and across Asia, but we also like Europe as well. And I think we're certainly getting some very interesting value opportunities arising within all markets. You know, I think we will see, you know, a decent recovery. What I would say, though, is that we do expect to see the momentum of growth globally slowing a bit in coming months and some rise in interest rates. In the case of the US in particular, we would expect policy rates to still rise more than the market is pricing. And that combination, I think, should slow returns. But we certainly don't think this is the start of a sustained bear market, mainly because we still believe that the global economic cycle will continue to remain reasonably robust. And therefore, this is more of a shakeout in a secular bull trend.
Stock of the day is Excel Industries. Excellent set of numbers reported by the company. If you look at the top line, we're looking at a 60% year-on-year growth for this company at a number of around 147 crore as compared to nearly 92 crore that we've seen in the corresponding quarter. While profitability, there's a 16-fold jump that we're looking at a number of 20 crore as compared to nearly 1.2 crore in the December quarter of the previous year. It has been a sharp, good performance even on operational front for this company. It's a good 6-fold jump that we're looking at in this counter at a number of around 32 crore as compared to nearly 4.8 crore in the corresponding quarter of the previous year. Also, if you look at the margins, it's a sharp jump at 21.6% as compared to nearly 5.3% in the corresponding quarter of the previous year. So what has led to good set of numbers will be higher revenue and also your lower overall cost, which has helped the operational performance of the company. Now, raw material cost as a percent to your net sales, that number has come down to 44% as compared to nearly 50% that we've seen earlier. Also, other expenses as a part of your overall net sales has come to 11% as compared to nearly 15% in the previous year. Finance cost for this company has come down good 12% year-on-year basis, which has in turn led to a good performance on the bottom line front. This is despite the other income significantly declining by 94% to a number of less than a crore in this quarter. In terms of segmental breakup that you would see, revenue from the continuing chemical business, which forms around 96% of your overall revenue, has shot up by 13%. Well, if you look at the EBIT performance of this segment, you would see the chemical business, ongoing business, contributes to 96%, and that business on year-on-year basis has registered multifold jump. With that, let's toss it over to Jayesh and Salori for commodity currency market updates.
Thanks for that, Nikki. Let me start off with the commodity space, which actually didn't have a good session overnight. All things commodities declined on all of the fronts. Let me start off with the oil prices, which posted its biggest loss in 2 months. Both WTI and Brent declined as much as 2% each. Now, this was on the back of weekly output that actually came in more than 10 million barrels for the first time in history. So, oil prices took that as a negative for them. And on account of this, the oil market volatility has now swung to the highest level since November. As far as base metals and precious metals are concerned, the important factor that weighed on both of these was the dollar index, which has shown some strength in the last 5 days. It has been trading higher for that time. On that instance, gold actually corrected by more than 1%, which was the most since December 7th that we saw last year. The LME base metal index, that actually declined to more than 2%, which is once again most since 5th of December. Nickel was down more than 4%. That was the top loser in trade. Copper was down nearly 3%. Zinc actually declined more than 2%, and other base metals like aluminium, lead and tin too ended lower on the London Metal Exchange. Now, similar cues can be seen on the Shanghai Futures Exchange, where most of these base metals are trading with a negative bias, with the exception of aluminium.
Well, amongst the stocks that we're tracking today morning is Sun Pharma. Now, that is on the back of its US subsidiary Taro reporting a very weak set of numbers. The net sales for the company fell by 30% on account of the tough business environment in US. Net profit also fell as much as 87% to just $18 million. A part of it can also be attributed to the change in the US tax laws. As far as the operating income is concerned, it halved to about $62 million, and EBITDA margins fell from 58% to 39.9%. So that's bad news as far as Sun Pharma is concerned. We might see some negative reaction there. FDC Limited has, the board has announced a buyback of 34.3 lakh shares at a price of 350 as compared to yesterday's closing price of about 250. The total buyback amount will not exceed 120 crores, and they've also said that the promoters will participate in the proposed buyback. So do watch out for that name. The other part, we're also tracking Uttam Galva Steels, where the company said that ArcelorMittal has transferred 29.1% of its stake in the company to founders. We're also watching out for the likes of IDBI Bank and Federal Bank, and this is on the back of an ET report which says that Manulife is leading the race to buy IDBI Federal Insurance, and that they may pay as much as $550 to $650 million to buy a controlling stake. So you could see some positive reaction on those two names. And lastly, we're tracking Shankara Building Products on the back of a bulk deal where Akash Prakash's Amansa Holding bought 1.7% stake in the company yesterday. And on the other hand, the seller was smaller cap World Fund Inc. The stock already ended about 4% higher yesterday, but you could probably see some, some further inch up in the stock price. But those are the stocks you need to watch today.
There was no change in interest rates, you know that already. There was also no change in stance. By that we mean that they maintained and kept the sentence which said that their monetary policy stance remains neutral. There was a section of the market which was concerned that they may take that out and then lay the road for an interest rate hike. They have not done that, so that came as good news for the markets, and you saw bond yields come off. But if you look at their growth and inflation picture, and it's important to look at both. Firstly, on the inflation side, they have 6 upside risks, but they have also put out some mitigating factors. So the 6 upside risks include HRA, that's the house rent allowance, that is getting built into inflation in a staggered fashion. There's the global growth recovery, which is impacting crude oil and other commodity prices. And then there are, of course, issues on the fiscal front, the MSP front, both of which have been added in after the budget. And then the final factor that they talked about was the higher customs duty. So that's the list of upside risks. On the mitigating side, they said that capacity utilization remains low, so that may keep a sort of a cap on how high inflation, or at least demand-driven inflation, goes from here. And then they also talked about the fact that oil has moved in both directions. So they gave out some mitigating factors. The other important factor to remember is what they have said on growth. Now, growth, of course, they're expecting it to recover to 7.2% GVA growth in the next fiscal. But there was an important comment on growth in the MPC statement where they talked about the fact that the committee is of the view that the nascent recovery needs to be carefully nurtured. Now, some of the economists we spoke to, in particular Shubhra Rao of Yes Bank, made the point that the MPC and the RBI want to give enough room for a pickup in supplies, and that by that I mean pickup in investment and a supply side response, as it's called in monetary policy. So perhaps in giving you a fairly balanced policy where they're highlighting the upside risk to inflation, saying that we don't want to jump the gun and start raising rates just yet, they have given you a fairly mature policy statement and policy view.
Okay, three large pharma companies will come out with numbers today, the biggest being Cadila Healthcare. A blockbuster set of numbers is expected on a low base last time around. So as far as the top line is concerned, we are seeing close to a 33% growth that will come in. Profit will grow by almost 90%, and we are seeing EBITDA grow to almost 100%. So EBITDA margins will come in at almost 26.5% versus 17.5%. The mainstay will be the US markets, because we are seeing growth of anywhere between 70 to 80% in the US markets. India will grow 10 to 15%. The others will grow anywhere between 10 to 15, 5 to 10%, 5 to 15% overall. Now, the main reason is the Lialda launch that happened in the US markets. So 65 to 70 million dollars will only come in from this drug only. So the base becomes extremely small, and the growth will come in from this drug. Incremental Tamiflu sales will also aid the revenues for the company, and that is something that will aid the company. The next one is Glenmark Pharma. So it's a contrast for Glenmark Pharma, because we are seeing revenues down almost 14%, profit down almost 50%, and margins will come in at almost 19% versus 30%. Now, the base was extremely large for Glenmark Pharma. Last time they had their key drug Zetia. So on that base, we are seeing a growth of almost 35 to 40% drop in the US markets for them. Pricing pressure and competition is definitely there in the US markets, and that will impact Glenmark. But there is decline as far as some of their key drugs, that is Mupizorin as well as Zetia. They will dent the numbers, but some key launches that they did will actually offset some of the losses that was there. India, we are seeing a growth of anywhere between 10 to 12%. And for Torrent also, we are seeing it will be a mixed quarter. Revenues up 7%, profit is down almost 4%, and EBITDA margins at almost 23%. So a stable set of quarters that is expected from Torrent. 5 to 7% US sales decline, given the fact that there is price erosion and competition that is coming in. Domestic business is expected to grow 12 to 15%. It's a strong base. Only 15 days of Unichem's financials will be consolidated, so now that's not very big. The main impact will come in the fourth quarter, and the PAT is going to be lower this time around, because last year what happened was the tax rate was extremely low for them. So the base for the tax becomes extremely high for them. So that's what expected from the three pharma companies today.
Galaxy Surfactants will be the fourth company to list on the exchanges today. Now, the company had raised close to 937 crore rupees at an issue price of 1,480. Now, the issue was subscribed total 20 times, with most of the demand coming in from the QIB portion, which was subscribed 54 times, followed by HNI side, which was subscribed nearly 7 times, and retail, which was subscribed nearly 6 times. Now, the street is expecting a premium of close to 70 rupees per share. That is a listing gain of nearly 5%. So let's see how the market capitalization of the company will stand on listing and how the valuations would look. So if you see at the issue price of 1,480, the market capitalization of the company would be close to 5,200 crore rupees. Now, if it lists at 1,550, the market capitalization would be close to 5,500 crore rupees, and if it lists at 1,600 rupees, then the market capitalization would be close to 5,700 crore rupees. So let's see how the valuations would look like on listing. If it lists at 1,550, the price to earnings would be close to 36.6 times. Market cap to sales would be 2.3 times. EV to EBITDA would be 21 times, while price to book would be 8.7 times. And if it lists at 1,600 rupees, then the price to earnings would be close to 38 times. Market cap to sales would be 2.4 times. EV to EBITDA would be 21.5 times, while price to book would be 8.9 times. So Galaxy Surfactants is a manufacturer of surfactants and specialty ingredients product. Now, surfactants is used as a raw material in products such as which are used for personal hygiene and sanitation, while special ingredients is used as a raw material in products such as sunscreen, fairness creams, etc. Now, the company generates most of its revenue by selling surfactants. It gets around 67% of its revenue from selling surfactants, while 33% from specialty. But going forward, it is looking to increase its focus on specialty products because they provide higher margin to the company. Now, the company sells its product in more than 70 countries and gets around 65% of its revenue from overseas market. It gets around 45% from Africa, Middle East and Turkey, while it gets only 35% from India and 20% from rest of the world. Now, the company's key clients include Henkel, Henkel, Dabur, Unilever, P&G, Colgate, and it generates, and from the top 10 clients, it generates nearly 59% of its revenue, and it shares a relationship of more than 5 years with its top 10 clients as of first half of financial year 2018. Now, if you see, the company has 7 manufacturing facilities, of which 5 are in India and 2 are in the overseas market. And the average capacity utilization of these 7 manufacturing facilities as of the first half of financial year 2018 stood at 62.5%. Now, in India, there are no sole manufacturer of surfactants. On the listed side, there are no peer which solely manufactures surfactants, but there are few players who manufacture surfactants, but the surfactants contribute a very smaller part to the top line, and those are Godrej Industries, India Glycols, and Aarti Industries. Now, if you see the companies, that is Galaxy Surfactants financials, the company's revenue, net profit, and EBITDA grew at a CAGR of 8.4%, 24.4%, and 7.5% over FY14 to FY17. Now, the reason behind the double-digit growth in net profit is that the company has been able to reduce its debt and interest burden over a period of time. Now, if you see the company's return ratios, they were very healthy. The return on equity stood at 24%, return on capital employed at 30%, and return on asset at 11.4% for the financial of 2018.
Well, 3 stocks to watch out for based on the delivery volume as of yesterday's trade. First up, we have Voltas. That was up about more than 2% and saw delivery buying in excess of 70 crores. The delivery volume more than doubled at nearly 12 lakh shares as compared to its 10-day average, and the total volume surged more than 3 times at about 48 lakh shares as compared to its 10-day average. Dish TV, the other stock to watch out for, that was up nearly 2% and saw delivery buying of more than 65 crores. The delivery volume shot up 140% at about 89 lakh shares as compared to its 5-day average, and the total volume more than doubled at nearly 2 crore shares as compared to its 5-day average. Natco Pharma, that was down in trade about 8% and saw delivery selling of more than 50 crores. The delivery volume was up nearly 50% at 6.5 lakh shares as compared to its 5-day average, and the total volume more than doubled at about 14 lakh shares as compared to its 5-day average.
Ayush and I have spent a day at the Auto Expo. It's been busy. There have been several launches. We can't tell you about all of them, but we can tell you about some of the coolest concepts here. The one behind me, of course, is the first launch that Maruti Suzuki did today, and that's the design philosophy that it intends to employ from here on out. What Ayush is standing with is perhaps what's more interesting between the two, and I'm going to let him tell you all about it. Ayush?
Definitely the more interesting of the two, because if you're adventurous and you like off-roading, well, then Maruti Suzuki thinks at this Auto Expo that the future is all about FACE. Alex, it's 4-wheel drive, autonomous, connected, and electric. Isn't that the theme?
Absolutely. Electric is what everyone's talking about. I can't imagine what an electric car would look like climbing up the face of a mountain.
And that's what this car can do. If this car was, well, from dreams to reality, if it actually made that transformation, well, you can actually switch and actually move from automatic to manual with the touch of the screen we're going to show you. Those are massive wheels for an off-roading experience. And have a look at that screen, Alex. That's out from straight out of a Star Wars or Star Trek movie there.
And don't miss the crystal ball. apparently that can connect all of your devices. It can do a lot of other things with regard to media over there. I don't know exactly what it's going to do, but it does look interesting.
It is. This is definitely one for the future. And well, the Jetsons and all those fancy futuristic movies and cartoons are not too far away, and it's not just here. There's a lot more to show you.
This vehicle is one of 2 that were showcased by Tata Motors today as concepts. This one is derived from the D8 of the Jaguar Land Rover.
Sounds interesting. The car looks fantastic. We can only hope the concept, well, is a lot like the real thing, and the real thing is a lot like the concept, but it looks spacious on the inside. We'll take you for a quick, well, walkabout. Massive tires. Alex?
So,
I take your point. I take your point now.
You know, essentially, this is what is called the Omega platform. The other one that they showcased is the Alpha platform.
That is for a much smaller car.
Yes. So the Omega platform essentially is going to be what the SUVs that they develop over the course of the next couple of years will be based on.
And this really showcases that finally, something we've all been waiting for, JLR and Tata, well, the synergies are showing in design and the product.
Design philosophy as well.
Well, there's more, and we're going to take you now to a race car, Alex. That, well, Formula E engine in that Batmobile-like car, well, should we take a ride in it?
I don't think they're going to let us take a ride in it. I was just going to say it looks like it's come out straight from a movie.
It has, Alice. And I think, well, we missed that bus. But just to let them know what we've all missed out on, 0 to 100 in what? 4 seconds? 360 horsepower.
I can only imagine how fast it goes.
And all electric.
I don't know. I can barely imagine how fast that would go, but then, look, that's what it's all about. It's a dream.
The Renault Trezor.
It's a concept.
The Renault Trezor is a concept. I wanted to add that as well. And well, it is a dream. And well, we thought we'd live the dream, but now what we'll have to do is hitch a ride and get back home.